Jeff. Is it a given that trade barriers will spark inflation?
Well, it's pretty mechanical that tariffs will translate into inflation. The amount is relatively small, at least for steel and aluminum, so it's almost a rounding error. The scope of the China IP potential reaction is much larger, particularly if they're targeting a broader set of products, particularly if they're on the higher end of some of the reported figures. So we've seen 30 billion, we've seen 60 billion. But if you do 60 billion and a 30% tariff, now you're starting to talk about real impact in terms of inflation. Yes, it does affect that.
Diane, full employment, could it be that we're still a long way away from it?
I don't think we're a long way away from it. Actually, what's really been interesting is the wages that we've seen in the beige book. It was one of the most bullish beige books we've seen since prior to the crisis on wage acceleration. Talking to clients across the board, everyone is increasing wages, trucker wages going up. This is something where I've been hearing for years and years and years. We don't have any truckers. Are you raising wages? No. They're not only raising wages, they're giving signing bonuses. Things are happening on a real-time basis that we're seeing happen now, and that's going to come through in the wage data. March is going to be a really funky number because we've got these nor'easters, and guess what? They hit during the employment week again, and so this is going to be March is going to be more noise. But I agree with Jeff. By June, you'll have a lot more data, and what the Fed's really looking for is that April CPI data too, and PCE data, because it comes out in April. It's the March data, where supposedly these transitory factors from the move to unlimited data in wireless that falls out, and we should see higher inflation. So if we don't see that, that's going to be something for the doves. If we do see that, they're going to say, hey, it was all transitory. Inflation's going up.
Yeah, that goes back to the idea that maybe the June data set or the June meeting is where the data comes into play more, because you can always dismiss anything that happens in the first quarter given that seasonal effect that we've seen in the last couple of years, right?
Right.
First quarter's always weak. Snow, exactly. All right, Diane Swank of Grant Thornton joining us from Chicago. She is sticking with us, along with Jeffrey Rosenberg of BlackRock. Let's get you a quick data check here as we head towards the Fed decision. You're looking at Dow that is elevated. It's up for a fourth time in 5 days, but pretty much stuck in a range after that February sell-off and rebound. Dollar weaker versus the yen right now by 1/4%. Dollar yen at 106.27. The 2-year yield currently at 2.33. Yesterday was at 2.34, so coming in a little bit here. WTI higher for a second day. U.S. inventories unexpectedly dropping for the first time in a month. The drawdown was the biggest since January. Traders say a geopolitical tension premium is starting to creep into the price. Of course, it's still very much range-bound as well. Now above $65 a barrel. Let's head now to Washington to Michael McKee, who is at the Federal Reserve with the latest on the Fed decision. Mike?
A quarter-point move, and the Fed gets much more hawkish over the next 2 years. As expected, Fed funds go to a range between 1.5% and 1.75%. That decision unanimous in Jay Powell's debut. But the real story is the dot plot. The Open Market Committee now just 1 dot move away from 4 rate hikes this year. In 2019, the median moves up to 2.9%, implying 3 moves. And in 2020, 2 more to a median of 3.4%. Their long-run forecast rate rises to 2.9%. Over the next 2 years, we get an additional 50 basis points of tightening. The economic forecast justifying the change. Their GDP outlook revised up to 2.7% this year from 2.5% and 2.4% in 2019 from 2.1%. Unemployment will be 3.8% by the end of this year, the Fed officials say, and falls to 3.6% in 2019 and 2020. Rising rates apparently will keep the inflation rate contained. PCE headline projection for 1.9% this year unchanged, and 2% next year unchanged. But for the first time, they forecast the inflation rate rising above their target to 2.1% in 2020 for both headline and for core. There is a new line in the statement, quote, "The economic outlook has strengthened in recent months." The statement looks at strong job gains, although recent data, it says, show household and business spending have moderated. Inflation remains below target, but should rise, and risks appear roughly balanced. So, welcome to the Fed, Jay Powell.
Jay Powell edition. Mike McKee, no dissents in Jay Powell's debut meeting as chairman of the Federal Reserve as well. So, all in all, what you told us sounds a little bit more hawkish. Do you get the sense, or do you feel that there's going to be some watering down, maybe a more dovish turn during the news conference?
I would doubt it. At this point, it looks like the Fed has moved in a decidedly more hawkish way. In the December statement, we had 10 of the 16 open market committee members at the time who were above 2% for a median. Now we've got 13 of 15, so a significant change, at least in the short run. Over the long run, still a wide dispersion. We have in 2020 one Fed official at 4.875%, almost 5% for the top rate, but we see them all kind of moving up along the dot plot curve for the next 3 years, decidedly more hawkish.
All right, let's now get some reaction from our guests, Diane Swonk and Jeff Rosenberg, who are still here. Diane, I'll start with you. What's your headline?
This is really the Fed saying we're going with the idea that fiscal stimulus is going to overheat the economy a bit, and we're ready to raise rates to deal with it. And that's a big move in confidence within the Fed. I think you're seeing a very strong influence by the composition of voters on the Fed as well. Many people thought Raphael Bostic would be more dovish. He's actually talked about more rate hikes this year, and you just saw it. That really is, I'm a bit surprised they went that far given the weak first quarter, but that's how confident they are that this economy is going to deliver.
Let's get your data check right now. If we can pull up the boards to show you how everything's reacting. I looked at equities, Joe, and you have a little bit of pop here and then coming right back down on that hawkish tone here in the statement as well. And if you look at the dollar, let's pull up dollar yen. Because before it, the dollar was weaker.
There we have the full
there
board.
We go.
Not a massive move anywhere, really. We still have 2-year yield unchanged, kind of remarkable. Dollar yen, not moving much. And equities, which had been higher going into the meeting, still higher, but not much. So I think overall, and we have lots to come still because we have the press conference. So far, not a ton of reaction to what we've seen.
Jeff Rosenberg, jump in here. What's the question you want to hear Jay Powell answer today?
I want him to talk a little bit more about the longer run outlook around fiscal policy. That's why I asked Mike to ask him that question, because I think that is really the critical question. I think there's a lot in here, but you look at the market reaction. The 2018 dots was right between 3 and 4. It came out at 3, so the front end of the curve doesn't move. It's slightly more hawkish, but not much more than market expected in terms of this was very much in the range of possibilities. And the statement sort of walked forward the data in a manner that was very much expected, and they left the roughly balanced in front of the balanced statement, so they could have been more hawkish there. And they certainly didn't have a more hawkish tilt relative to the trajectory of rates following this rate hike, which would have been a much bigger hawkish tilt. So I think you're seeing this kind of down the pipe in terms of market expectations. It's validating those expectations, but a lot of those expectations were already built in. I think you see that in the market reaction here.
Mike, you had mentioned that the inflation targets go up a little bit, 2.1% for 2020, for instance, both headline and PCE core. Do we get any sense from the statement at all on how willing the Fed will let inflation go above 2%?
No, it doesn't really come through there. And, of course, in the long run, they expect inflation to go back down to 2%, their long-run median forecast. So that's a question for Jay Powell is, will he let the inflation rate be symmetric? Would it be okay to go above 2% for a time? Obviously, they forecast it's going to happen, but the question is how quickly do they bring it back down?
All right, Mike McKee, we got to let you go so that you can get ready for the news conference where Mike will be asking his question, Jeff's question, probably Joe's question as well. Michael McKee going off to the news conference with Jay Powell. In the meantime, we have with us Diane Swonk from Grant Thornton and Jeffrey Rosenberg of BlackRock.
Diane Swonk, you saw unemployment rate expected to drop below 4%. As you said we're fairly close to what you would estimate full employment is, but we keep dropping lower without that kick up in wage inflation that a lot of people would have expected. Is that just a matter of it's still coming, or is it a matter of maybe we have to rethink the link?
I do think it is still coming. I don't think we need to rethink the link. I think we did see a lot of people join the labor force last month. I said the data for March is going to be a little wacky because we did have another nor'easter during the week of the employment report. But I do think it's coming. I think what you're going to see is this is a Fed that is now affirming the strength of the economy, which, you know, it's yes, they're raising rates, and yes, they're bullish about the outlook. 3.6%, not hard to get to at all. In fact, I think it's a little conservative on their part, the way they have their unemployment rate posted out there, which means they still expect to see some increase in participation rate given these growth rates, and a little increase in productivity growth as well. That 2.1% on inflation in 2020 is the real, as Mike said, does the Fed, this is going to be the next big debate, is the 2% a ceiling or is it symmetric? Of course, Charlie Evans would say it's symmetric of the Chicago Fed. It's not clear where this Fed's going to come down on that. This was a sign that perhaps they see it as symmetric, but that's going to be really critical, is how much inflation will they tolerate as the unemployment rate falls, perhaps lower than what they have forecast.
Yeah, and it's something Ian Shepherdson of Pantheon Macroeconomics pointed out in his note earlier, that Powell is trained as a lawyer, so he knows how to respond to potentially awkward questions without answering it. During the testimony to Congress, he never really answered the question on how willing he was to let inflation go above that 2% target.
Yeah, what's your read on how he views the 2% inflation target, whether he sees it symmetric or a ceiling?
So I think it's definitely not a ceiling, and I think he'll adopt some of the notion that we've heard other policymakers use, which is overshooting versus overheating. That a little bit above 2% is okay. Even if you look at the forecasts here, you know, 2019 up to 2.1, 2020 up to 2.1%, but they're running an unemployment rate for the next 2 years at 3.6% as compared to a longer run forecast of 4.5%. Right. If that doesn't generate more inflation than these inflation forecasts are looking at, they're going to have some real questions about the validity of either their models or the validity of those forecasts. And we're going to focus in June on whether or not that 2.1 needs to go up, particularly in light of what we're seeing in terms of shorter run inflation data running well above target. So this is going to be a key focus.
How does this change the thinking, perhaps, Diane Swank, of what central banks around the world, the ECB, the BOE, the BOJ, does next? Does it have any impact on them?
Well, I think you've got sort of the ECB is about 2 years behind the Fed, and so they're clearly moving towards, you know, tapering. They're already effectively doing it, and they'll be eventually raising rates. But I think the real issue is that right now the Fed is the leader, but we have synchronous world growth as well, which is one of the disinflationary effects out there. So I agree with Jeff that the inflation numbers are going to really come into question. These numbers don't square, and you sort of understand why they don't, because we haven't seen the whites of the eyes of inflation yet. We haven't seen the actual data yet, so they don't want to get ahead of the data. That said, the forecasts themselves don't all add up, and June will be a critical meeting in terms of understanding that. I also think in June, I think we're going to see this Fed chair willing to have a press conference at every meeting, reintroducing the idea that every meeting is live, because markets too much are expecting only a meeting with a move with a press conference, and they've really got to react to the data, and they've got to be able to be data reactionary, and they need to be able to look like they're more flexible. And I think we got to take out of the markets this expectation of only every press conference that they actually move.
Yeah, in theory, every meeting is live, and they've stressed that repeatedly, but we know in practice it's only been when they've held the news conference.
And markets have never believed it, because you can just see they never expect a hike during the non-press conference meetings.
All right, Diane Swank, stick with us. Jeffrey Rosenberg, of course, of BlackRock, still with us as well. We want to bring in Al Brodus now. He's a former Richmond Fed president and joins us right now from Sarasota, Florida. Al, what do you see in the Fed statement that catches your eye?
Well, it's as people have said, it's a bit more hawkish than the last one, and that might be a bit of a surprise. To be perfectly honest with you, I thought they might go all the way to a projection that with the dot plot that we would have 4 increases this year. I think, as I understood what I heard, it's just shy of that. But it's not surprising given the data that and what's been happening over the last 6 weeks or so that you get this somewhat more hawkish position. Monetary policy in many ways is an exercise in risk management. And so there are lots of risk out there, but one that they are particularly concerned about is that with this fiscal stimulus, with the tightness in the labor market, with the indications of at least some marginal increases in labor cost, the inflation, the risk of inflation is now rising. Not a lot. It's not at the doorstep, but it's something to be concerned about. So in order to deal with that, they are signaling that they're ready to not let the Fed get behind the curve as it has sometimes in the past. That's the big risk I think many people at the Fed would be worried about. Because that's the situation where when the Fed gets behind, it has to raise rates aggressively, and that leads to recessions. I think they want to signal that they're aware of that risk and take actions to try to prevent it.
Al, what would you ask if you were at the press conference? What do you most want to hear to gain insight into the chairman's thinking?
Well, I think I would probe to see how concerned he, there's a balance of risk, and the statement says the risk is balanced. And I would try to probe to get some sense of where he sees the principal risk to be. If I had an opportunity, we're talking now about the upside risk, but there's still a downside risk. Inflation, actual inflation is still low. Interest rates are low. There's still this issue with the lower interest rate bound if the economy should move unexpectedly in the other direction. How would the Fed react to that? I would like to kind of get some sense of how prepared he is to deal with either of these outcomes if he gets them. Those would be the main questions I think I would have on my mind.
Yeah, very specific questions and outcomes there. Al Brodus, former Richmond Fed president, with us on Bloomberg Television, on Bloomberg Radio. This is The Fed Decides. I'm Scarlett Fu here with Joe Weisenthal. Tom Keene actually off for the day. We also have with us Diane Swank and Jeffrey Rosenberg as our guests for the moment as we await Jay Powell's news conference. I was just looking through MLive Go, which is our Markets Live blog, to kind of follow this Fed decision. And Cameron Kreis, our Bloomberg macro strategist, Jeff Rosenberg, who was just on with us earlier, was looking through the statement, and his assessment was more growth, more employment, more inflation. It implies a somewhat greater risk of policy error as well because we have a hawkish outcome. Do you agree with that?
Well, I think what he's getting at is the statement of economic projections were pretty bullish in terms of upgrading. They're not as bullish as sort of where the market consensus is in terms of their growth numbers, but it is an upgrade in the context of still very gradual normalization. So if you kind of extrapolate that trajectory out, if the economy continues to upgrade, if we get that upgrade on inflation that I was talking about before, while the Fed is still stuck to this very slow pace, then you could sort of say that the tilt to the risk is, hey, are they getting behind the curve? I think it's way too early for that, and I think that's why you got only 3 hikes in the median dot for 2018. But we'll see where that evolves by June's meeting. But I think it's a little bit early to go that far.
Diane, we are seeing risk assets pick up a little bit here. Is that basically because, as Jeffrey described, that dynamic where it seems like the expectations for the economy are perhaps accelerating a little bit faster than the pace of expectations for the hikes themselves, which could be implied as being somewhat dovish?
It's not dovish, but I do think there is a gap there, and I think Jeff has really laid it out very well about, the consistency. But there is this issue that the Fed is dealing with, and they've been consistently wrong on wages going up and consistently wrong on timing of inflation. And until they see the whites of the eyes of inflation, they can't. They're anticipating that, but they can't really match the forecast. And I agree with Jeff. June is going to be very illuminating. May could be illuminating as well as they shift the statement to reflect depending on the data that comes in. But frankly, by June, we should have a much clearer picture of whether or not this inflation we've seen is transitory. I think the Fed also is looking at, if you look at things like the purchasing power, the PPI, final demand, that actually on services has accelerated quite dramatically, which is crimping margins, and it's exactly where you would see it in the service sector, the domestic service sector, rather than in goods. And those are signs that pipeline inflation has picked up as well, which they're looking at. And at some point in time, that's either more narrow margins or some spillover in price increases. So they're looking at all the dynamics, but the numbers don't quite square yet, and that's because we haven't seen the reality, and they've been humbled a few too many times.
Yeah, and we have to wait for the data to bear it out. And as Diane mentioned, June will be important because that's the next live Fed meeting. That is when the next press conference is scheduled. Al Brodus over in Florida, Diane was talking earlier about how Jay Powell, the new Fed chair, should change the schedule to now hold a news conference after every Fed decision, make every meeting live. Do you think that's something he should do?
I think that would be an awfully big burden on the chairman. And, you know, there's a point at which there's too much information. I don't think it should be rigidly, we're going to only have moves at a press conference. And you could add a press conference if circumstances in a particular situation demanded. But I would not go to a program of regular press conferences after each meeting. I think that's a little too much.
Well, Al, another way that he could make it clear that every meeting is in fact live is to just get rid of the press conference entirely, which is how it had obviously been done for years up until the immediate post-crisis period. Is there a case to be made that now that things are quote-unquote more normal, that we could just go back to a more normal style of Fed communication?
Good question.
No, I wouldn't do that either. I think what we have now, 4 press conferences a year, strikes me as about right. You know, a quarter goes by. That's enough time to get some sense of significant movements one way or the other in the economy, in market expectations, inflation expectations, and so forth. And so it's, you know, it's an opportunity once every 3 months to sort of take stock. And I think that strikes me as about right. Again, if something comes up that requires the chairman, of course, he's out in public anyway, testifying, occasional speeches, some Q&As here and there. It's not like he only speaks at press conferences.
Right.
So I don't know. I think the balance now of what we have is about right, and I don't think I would change it.
What would we do, Jeff Rosenberg, if we didn't have press conferences anymore? We couldn't have a Fed special for 2 or 3 or 4 hours at a time.
Well, gee, what would we do if we went back to pre-Feb 1994 right. when there wasn't even a statement? Al, you I think have a better insight on that. Could we go all the way back out to the pre-open
I don't think we should. Look, I can remember I started in the Fed in 1970 when Arthur Barron's was chairman, and there wasn't much transparency back then, as I'm sure you know, and that was not a good situation. So we've definitely moved in the right direction. I think you can get to the point where there's so much information, so much noise out there that it's confusing. And, of course, the Fed needs to communicate. Its credibility depends critically on communicating clearly to the public. So, you know, I think we've come a long way in the right direction. I think we're where we need to be right now in terms of clarity. I don't think lack of communication is any longer, from the Fed itself and from the chairman, is any longer a significant problem.
Diane,
so I'm okay with where we are.
Diane, other than going to a press conference at every meeting, when you look at communication as a policy tool, are there any areas that you think that should be revisited?
There's a lot of areas that should be revisited. You know, we can name the dots. Of course, we can all pretty much pick them out anyways. It's a game. It's a parlor game of who's got what dot. I do think, actually, so the reason that Chair Yellen didn't go to more press conferences was because how much she prepared, and Jay does prepare, Chairman Powell does prepare a lot for press conferences as well. That said, you can have a very short press conference, and Chairman Powell, there is a widespread consensus within the Fed that they should do this, and that's why I think they're going to do it, and I think it's his way of marking it where he can have a short press conference. He doesn't have to say much if there isn't much to say. He doesn't have to have that forecast. He can still keep the forecast to every quarter. I think there's a lot they can do in terms of improving the forecast and how they have their reaction function. We really can get I think he's going to add transparency in a simplistic way. He also colors in the lines. I think he stays within the lines. You're not going to see Chairman Powell go on a deep dive, as we've already seen. He was asked about income inequality. He's like, well, listen, that's not in our bailiwick. That's not within what we can do. He's very much, as a non-economist and someone who wants to be more plain-spoken, stays within the Fed's mandate and really wants to color within the lines. And that gives him more latitude to actually have a press conference at every meeting and not say a whole lot. And I think that's important too, but it also gives a sense of transparency of what they're thinking and how it's evolving. And it gives him control in a situation where right now the presidents dominate. He's got 2 allies sitting next to him plus the New York Fed. All the rest of the presidents now dominate the vote on that FOMC.
Yeah.
And having that control for him, I think, is important right now until we get some staffing at the FOMC.
And we're waiting, of course, Jay Powell's first news conference. It'll come up in about 8 minutes and 45 seconds. We've got a countdown clock here at the bottom of our screen. Al Brodus, how else should Jay Powell put his stamp on monetary policy or the process? Is this something he should be doing actively?
I'm sorry, could you say that again?
Should Jay Powell be actively trying to put his stamp on monetary policy or the process of making monetary policy?
I think so, probably, yeah. I think he needs to be actively engaged with his staff. Keep in mind, he's been there for 5 years, so I think he's pretty much up to speed already. But he will need to have that good contact, and I'm sure that he will.
Al Brodus, thank you so much for joining us. Al Brodus with his reaction, his response to the Fed decision. Al Brodus joining us from Sarasota, Florida. We are, of course, back here with Diane Swonk, chief economist at Grant Thornton in Chicago, and Jeffrey Rosenberg, BlackRock's chief fixed income strategist. There we go. This is The Fed Decides on Bloomberg Television and Bloomberg Radio. I'm Scarlett Fu, here with Joe Weisenthal. Let's bring in now Ira Jersey, Bloomberg Intelligence U.S. rate strategist, who joins us by phone. Joe?
Ira, what do you make of the market's reaction to the announcement?
Yeah, it's really mixed. You know, the knee jerk was kind of unexpected, I guess, and the fact that you have 2-year notes now trading a couple of basis points better, so yields are a little bit lower than one might have expected, particularly in light of the fact that the Fed's dots went up. So when you're looking at kind of the Treasury market reaction to this, it's a little bit odd that you have front end rates coming down while you have longer end rates going up in a more hawkish Fed environment. And I think that's interesting. I mean, the market's moving very quickly. So when you look at other front end instruments like December 2019 Eurodollar or Fed funds futures, they've been all over the place, all over the map, and are now right about nearly unchanged from where they were before the announcement.
Jeff, it looks like your call to buy the short end at least working out in the last few minutes.
I think it's pretty good, and I think the 2-year makes a lot of sense. I'll disagree a little bit with Ira here that, you know, the market was somewhere between 3 and 4 dots, so maybe you were pricing in 3.5 and you came in at 3. 2 years most sensitive to that, so I think that makes sense, and I think the uptick a tiny bit in terms of the longer, the 19 and the 20 dots, kind of within the realm of market expectations, and you see that in the 7 and the 10-year, and not a big move to the back end because they didn't surprise at all on that longer run dot. I think the market reaction, let's not overthink these very small moves. The Fed delivered the market expectation, so check that box, and what we're about to get in terms of the press conference is Powell trying to just get out of the press conference without rattling markets, deliver what the market expects him to deliver.
Diane, jump in.
Oh, no, I agree entirely with Jeff. I mean, he's going to be treading carefully to not trigger anything, and I think that's exactly right. I agree with Jeff 100%. Is his job right now is to not do a slip up, is to just sort of stay the course, stay away from tariffs, stay away from any commenting too much, but be bullish and affirmation that the economy is good. That keeps him in a nice neutral spot. But this is kind of, you know, the forecast, as Jeff has already laid out, and I have too, it kind of looks a little Goldilocks-ish, given the low inflation numbers, and, you know, that's going to change. Or it won't, and they're wrong. So, you know, we're seeing a lot of real-time evidence. I agree with Jeff that things are picking up and inflation will pick up and wages are picking up. We're seeing all that on a real-time basis. It's still got to show up in the data. The Fed has to wait for the data.
Ira, where could the 10-year yield go in the medium term?
Yeah, so we could certainly see in an environment where the Fed is viewed as a little bit more hawkish. I think it ends up being harder, actually, going forward for the 10-year to see significantly above 3%. You know, that being said, I do think sometime this year we're going to see 3%, probably break it. There'll be a lot of headlines. You guys will be talking about it quite a lot. And but at the end of the day, if the Fed is going to be more hawkish and kind of clamp down on rising inflation expectations, then it's going to be harder and harder for the 10-year to sell off, in my view.
You know, we were talking about how Fed policy is slowly becoming more normalized. We need to think of things in that fashion because the period of emergency accommodative measures is over now. I wonder, though, a lot has changed since before the crisis, clearly. Do you worry that monetary policy is less effective or could become less effective because the economy itself has changed so much? It's less capital intensive. It's more driven by services. The kinds of jobs that drive the economy are different than what it was before the crisis.
So it's a question about monetary policy transmission, and there's a lot of uncertainty about monetary policy transmission, particularly with what you alluded to, unconventional monetary policy. And we really don't know. And it's a reminder that throughout this entire communication, nobody's talked about the balance sheet. And we don't talk about the balance sheet because the Fed doesn't talk about the balance sheet anymore. But the intentionally. But the balance sheet is still operating on financial market conditions in the background in a manner that we're not completely certain of. We know that it's having an impact on the net amount of private sector requirements to fund an increase in fiscal borrowing this year, and that's having a major impact in terms of the outlook of term premium and interest rates. So, yes, I mean, a lot of that stuff is still very uncertain as to how the stuff we're focused on today works with not just the Fed's unwinding of its balance sheet, but also there's a global context to this as well around the ECB and the BOJ.
Diane, do you want to weigh in there?
Yeah, I just want to echo that and actually ask Jeff this because it's something that really sort of, the Fed's on autopilot. We're going to reduce the Fed's balance sheet by about $500 billion, half in mortgage backs and half in Treasury bonds this year. And they really just assume, because they've laid it out, and that was a decision they made prior to the fiscal stimulus and the issuance of a lot more Treasuries and the global situation that we've got. They sort of think the markets just have that completely priced in, and that removing of the ceiling that they're doing slowly, that it won't have any disruptive effects. What's your read on that? That's something that I have a lot of skepticism about because I think it's just an unknown in terms of what's actually going to happen as the Fed continues to up how much they allow their balance sheet to shrink. They shrink their balance sheet at a faster pace over the course of the year.
So if I can jump in here on that one, one of the interesting things is that the Fed's caps will only be met 4 times a year. So actually, the runoff of the Fed's balance sheet will not be anywhere close to the pace that they that the cap suggests. So one of the things is that I think for Treasury issuance, it's really the deficits that matter far more than the Fed's balance sheet. I mean, the deficit is going to trump. No offense, that was not a pun intended, but it's going to be much larger.
It's a large deficit, yes.
Yeah, it's going to be much larger than what the Fed's runoff is going to add. So incrementally, the Fed runoff is going to mean higher issuance, but that's nothing compared to the $800 billion to $1 trillion deficit that we're going to have.
So adding to Ira's points, Diane, the other issue is that the Fed is getting out of its balance sheet in a passive fashion. They did that because they didn't want to signal anything. However, it's very asymmetric to how they got into the balance sheet. They got into the balance sheet explicitly across the curve in a market-neutral way. But the way in which they're exiting the balance sheet is not market-neutral with respect to the maturity of the bonds that they hold. They get rid of their shorter maturities. They hold their longer maturities. So there's a passive emphasis effectively in the Fed's balance sheet normalization to flatten the curve. And this is not necessarily what they would want to have happen. And it's happening at a time when the fiscal policy, all the accelerated issuance in the front end of the curve, is also pressing on a flatter curve. So they will potentially in the future face a question. If the curve gets really flat and they don't want to invert the curve, do they reintroduce in some fashion a speech, a staff research? Do we go back towards a more active approach, Operation Reverse Twist, for example, to manage the maturity profile? Far too early to have that debate today, but it is something that could come back on the horizon.
It's something that they're certainly probably thinking about and talking about in the halls of the Federal Reserve. Diane Swank of Grant Thornton, chief economist there, joining us from Chicago. We also have with us Ira Jersey joining us by phone. He is a Bloomberg Intelligence interest rate strategy, and Jeff Rosenberg, chief fixed income strategist at BlackRock, our guest host for The Fed Decides. Now, of course, we are awaiting Fed Chair Jay Powell to take the podium. This will be his first news conference, and he has just entered the room. Mike McKee should be in there as well, asking his questions. Let's go now to Washington, D.C., where Jay Powell is getting seated and ready to host his first news conference as chairman of the Federal Reserve. First, he needs a drink of water, putting on his glasses, getting his papers in order.
I have a brief statement, and then I'll be happy to respond to your questions. The job market remains strong, the economy continues to expand, and inflation appears to be moving toward the FOMC's 2% longer run goal. As you already know, we decided today to raise the target rate for the federal funds rate by 1/4 percentage point, bringing it to 1.5 to 1 3/4%. This decision marks another step in the ongoing process of gradually scaling back monetary policy accommodation, a process that has been underway for several years now. Job gains averaged 240,000 per month over the past 3 months, well above the pace needed in the longer run to absorb new entrants into the labor force. The unemployment rate remained low in February at 4.1%, while the labor force participation rate moved higher. Over the past 4 years, the participation rate has remained roughly unchanged. That's a sign of improvement, given that the aging of our population is putting downward pressure on the participation rate, and we expect that the job market will remain strong. Although the growth rates of household spending and business investment appear to have moderated early this year, gains in the fourth quarter were strong, and the fundamentals underpinning demand remain solid. Indeed, the economic outlook has strengthened in recent months. Several factors are supporting the outlook. Fiscal policy has become more stimulative. Ongoing job gains are boosting incomes and confidence. Foreign growth is on a firm trajectory, and overall financial conditions remain accommodative. Against this backdrop, inflation remains below our 2% longer run objective. Overall consumer prices, as measured by the price index for personal consumption expenditures, increased 1.7% in the 12 months ending in January. The core price index, which excludes the prices of energy and food and is typically a better indicator of future inflation, rose 1.5% over the same period. However, as we have noted for some time, the shortfall of inflation from 2% reflects, at least partly, some unusual price declines that occurred nearly a year ago. In coming months, as those earlier declines drop out of the calculation, inflation should move up closer to 2% and stabilize around that level over the medium term. Of course, various forces will continue to affect inflation. At times, it may be above 2%, just as at times it may be below. Our inflation objective is symmetric in the sense that we are trying to prevent persistent deviations from 2% in either direction. Based on the projections that committee participants submitted for this meeting, the median projection for the growth of inflation-adjusted GDP is 2.7% this year, 2.4% next year, and 2% in 2020, a bit above its estimated longer-run rate. The median projection for the unemployment rate stands at 3.8% in the fourth quarter of this year and runs at 3.6% over the next 2 years, almost a percentage point below the median estimate of its longer-run normal rate. Finally, the median inflation projection is 1.9% this year, 2% next year, and 2.1% in 2020. Compared with the projections made in December, real GDP growth is stronger, the unemployment rate is lower, and inflation is slightly higher. As I noted earlier, today's decision to raise the federal funds rate is another step in the process of gradually scaling back monetary policy accommodation as the economic expansion continues. This gradual process has been underway for more than 2 years, and it has served and should continue to serve the economy well. In making our policy decisions over the next few years, we will continue to aim for inflation of 2% while sustaining the economic expansion and a strong labor market. In the committee's view, further gradual increases in the federal funds rate will best promote these goals. By contrast, raising rates too slowly would raise the risk that monetary policy would need to tighten abruptly down the road, which could jeopardize the economic expansion. At the same time, we want to avoid inflation running persistently below our objective, which could leave us with less scope to counter an economic downturn in the future. Participants' projections of the appropriate path for the federal funds rate reflect our gradual approach. The median projection for the federal funds rate is 2.1% at the end of this year, 2.9% at the end of 2019, and 3.4% at the end of 2020. By 2020, the median federal funds rate is modestly above its estimated longer-run trend. Most participants revised up their projections since December, although the median projection for this year did not change. The medians for 2019 and 2020 are somewhat higher than in December. Of course, we'll be watching how the economy evolves in the months and years ahead relative to our maximum employment and price stability objectives. If the outlook changes, we will adjust monetary policy appropriately. Finally, I'll note that our program for reducing our balance sheet, which began in October, is proceeding smoothly. Barring a very significant and unexpected weakening in the outlook, we do not intend to alter this program. As we've said, changing the target range for the federal funds rate is our primary means of adjusting the stance of monetary policy. As always, the committee would be prepared to use its full range of tools if future economic conditions were to warrant a more accommodative monetary policy than can be achieved solely by reducing the federal funds rate. Thank you, and I'll be happy to take your questions now.
Steve, please.
Mr. Chairman, right, the microphone. Mr. Chairman, welcome. Interesting changes in the forecast. A higher growth forecast, a full point above the long run, lower unemployment, 7/10 below the long run, and yet very little change in inflation. What does that say about what you and the committee believe about the inflation dynamic? And how is it that in that context you justify 3 rate hikes this year and ostensibly 3 next year and a full $600 billion, I guess, annual rate decline in the balance sheet? Where's your biggest concern here? Is it in overkill when it comes to rates or underkill?
So you're right that the outlook did improve, as I mentioned, and as was in your question. The committee's estimates of growth went up, the committee's estimates of unemployment went down, and there was a very slight increase in inflation. And I think that reflects essentially, if you think back to the era after the crisis, unemployment was 10%. It's now 4.1%. You've only seen very gradual upward pressures on inflation and wages despite that very large increase. And that suggests that the relationship between changes in slack and inflation is not so tight. But it has diminished, but it's still there. So I think when you see those small changes in unemployment, that simply reflects the flatness of the Phillips curve, if you will.
And your biggest concern, your biggest risk here, is it doing too much, doing too little?
I think we're trying to take the middle ground there. So, on the one hand, the risk would be that we wait too long and then we have to raise rates quickly, and that foreshortens the expansion. We don't want to do that. On the other side, if we raise rates too quickly, inflation then really doesn't get sustainably up to 2%, and that will hurt us going forward. We need that, and we need to make sure that inflation expectations are anchored at 2%. So we're trying to take that middle ground, and the committee continues to believe that the middle ground consists of further gradual increases in the federal funds rate as long as the economy is broadly on this path.
Go to Nick and then to Jim.
Thanks. Nick Tamaros of the Wall Street Journal. Chair Powell, I want to ask about the symmetric inflation target. What you outlined in your remarks is preventing persistent deviations. I want to understand what symmetry means in the context of inflation being allowed to run above the 2% target, now that that's part of the projection for, at least for core PCE next year. How do you define symmetric relative to the experience of the past 5 years? Would the Fed be willing to accept the type of overshoot of its target as it has seen during the undershoot? And how high above 2% is too high to maintain a target that is symmetric? Is it 2.25, 2.5, 2 3/4? And also, for how long?
So as you noted, what we've said in the longer run statement of goals and monetary policy strategy is that we would be concerned with sustained or persistent deviations of inflation either above or below. We've also said in minutes and in speeches and things like that that is a symmetric objective. So that's how we think of it. And I think I wouldn't characterize what we've done over the last 5 years as tolerating an undershoot of inflation. We were always pushing toward 2%, and I think that is how we look at it. I can't give you an exact number. It just, we haven't agreed on that. It just is that we're always going to be seeking 2% inflation. And in doing that, we're going to be considering, by the way, the other side of the mandate. We have to balance that against the deviation of unemployment from its goal, and also just the duration of it as well.
Hi, Mr. Chairman. Jim Puzengaro with the LA Times. Even with the extra fiscal stimulus of the tax cuts, your median growth projection is just up to 2.7%, and then this year, and then drops back down to 2% by 2020. Is the continued talk in Washington about tax cuts bringing growth to 3% or higher on a sustained basis overselling their potential impact?
Let me say what that really is. So the summary of economic projections is really a compilation of the individual rate forecasts. The committee made really one decision at this meeting, and that was to raise the federal funds rate by 25 basis points. The summary of economic projections is individual forecasts compiled and written down. And you've identified the median as 2.7%. And that's an interesting statistic. I would also say that the central tendency is interesting, the full range is interesting. So you have a range of views around the table. One of the great benefits of our system is that we do have reserve banks with their own staffs and governors with different views, and so we discuss these things. So the committee doesn't vote or agree upon the medians. So you're going to have a range of views. That's really all I can say. 2.7 just happens to be the median for 18, but it doesn't really say, what we think is possible.
But do you think you can get to 3% on a sustained basis?
I would say it's hard to say, but it would take, that is well above almost all estimates, current estimates of potential long-run growth. It would take, significant increases in productivity and labor force participation to get there.
Gina.
Hi, Gina Smilik with Bloomberg News. So obviously you guys reduced your NARU estimate slightly today, but if you continue to see job gains around 200,000 a month, prime age labor participation rising slightly, pretty sustainably, moderate wage increases, at what point are you guys going to start to question whether you're actually overshooting full employment? And if you start to question that, how is that going to impact policy?
So I guess I'd start by saying that the natural rate of unemployment is not something that we can observe directly. We look at a wide range of indicators on that, 15 or 20 of them at least. And also I think we all understand that any point estimate is surrounded by very wide uncertainty bands. So as the actual unemployment rate has declined from 10% to 4.1%, the committee's median estimate of the natural rate of unemployment has also declined by a full percentage point. So the committee, and I think people are generally influenced by data. As they see unemployment going lower, they're looking at a variety of aspects of the labor market, including wage inflation and price inflation. So I don't think we're mindful of the uncertainty of that, and we'll be looking at that. So if unemployment does continue to go down, we'll continue to do that. As I mentioned earlier, there's no sense in the data that we're on the cusp of an acceleration of inflation. We have seen moderate increases in wages and price inflation, and we seem to be seeing more of that. We'll be alert to that. I guess the theory would be that if you get below the sustainable rate of unemployment for a sustained period, you would see an acceleration of inflation. So we would know that then, and we're very alert to it, but it's not something we observe at the present.
Sam.
Thanks very much. Sam Fleming from the Financial Times. You and other policymakers have talked about headwinds turning into tailwinds recently. Does that imply that you think now a higher neutral rate of interest is operative in the U.S. economy, and how would you assess the implications for monetary policy? Second question, this is obviously your first press conference, so it's a little early to ask this question, but would you like to do this more often? Thanks.
Longer run values like the neutral rate of interest, the natural rate of unemployment, the potential growth rate of the economy are pinned down by slow moving forces over time. So they don't move around very much. So I wouldn't expect the committee's predictions or projections or estimates of those values to move quickly. They'll move slowly. So is it possible that the neutral rate of interest would move up because of for example, greater fiscal expansion? There's literature that says that. There are reasons that might be the case. In fact, it did tick up 1/10, as you will know, in the in the median at this time. But it's, I think, generally speaking, the committee sees the neutral rate of interest as still quite low, and is not seeing it as having moved up, and is open to the possibility that it will. Press conferences. So that's something that I'm going to be carefully considering. I have not made a decision about it. My colleagues and I are committed to communicating as clearly as possible about what we're doing and why we're doing it. I would want to think very carefully about it and make sure that no one would take more frequent press conferences as a signal of the path of policy. And so it's something that I'll be thinking about.
Hey, Anna.
Adam Shapiro with the Fox Business Network. You brought up the fiscal stimulus and the impact it's having, and I was curious, how is the change in the federal budget deficit, because the stimulus is coming with great debt, has it changed your approach to how many securities you're going to allow to roll off the balance sheet, and is there a level of Treasury supply at which the Fed would consider adjusting its balance sheet roll-off, given how much the U.S. government's going to have to borrow going forward? And then a second question, things beyond your control. The president's expected to announce new tariffs against China. And does the committee discuss what potential impacts that could have in regards to inflation? And do you have a timeline as to how you would respond to that?
So in terms of the balance sheet, we've said that we carefully developed this plan. We carefully socialized it in a series of meetings last year. We announced it, and we said we wouldn't change it really unless there were a significant downturn that required meaningful reductions in interest rates. And I have no inclination to revisit that. We're going to use monetary policy as the principal tool of adjusting our policy. So on the second question on tariffs, a number of participants in this FOMC did bring up the issue of tariffs, and if I could summarize what came out of that, it was first that there's no thought, I think, that changes in trade policy should have any effect on the current outlook. Second thing is, I would say, is that a number of participants reported in about their conversations with business leaders around the country, and reported that trade policy has become a concern going forward for that group.
Marty Krutzinger with the Associated Press. You talked about the fact that the summary of economic projections is based on the outlook of all the members of the FOMC. Can you tell us anything, though, about the staff forecast and how that was impacted by we had a $1.5 trillion tax cut. We've had $300 billion in increased government spending. The staff forecast that you're working with, are those reflected? How were they impacted by that, and how did that impact the discussions?
So we look at the staff forecast and the board forecast, and by the way, there are 12 excellent Reserve Bank staffs who have their own views and do their own work. We look at those as informing the decisions of the policymakers. So, and it's really the policymakers' views that we talk about in the SEP. We don't talk about the staff forecast. It's a particular thing done under particular rules and circumstances, and really it's the policymakers that then take that as input and create their forecasts, which are what drive policy.
That had no impact, though? That's a major increase in government stimulus that had an impact on the discussions, I would think.
Well, you're right. So fiscal stimulus is a meaningful input into the SEP and particularly in the changes over the course of last year and this year. And individual policymakers went through with their staffs a range of estimates, a range of literature, and did their own thinking and came up with their own estimates and submitted those as their summary of economic projections, as their projections. Those are not the staff's projections; those are our projections.
Heather Long, Washington Post. What will it take to get to 4 rate hikes this year? It's clear from the dot plot that many members do think 4 would be appropriate, but clearly something was holding a number of the FOMC members back. Is it concerns about
This is the Fed Decides on Bloomberg Television and Bloomberg Radio. You are listening to Jay Powell host his first news conference as Fed chairman after the Federal Reserve raised interest rates by 25 basis points. Let's listen into the news conference.
The median, even though the economic projections look very healthy.
I would go back to the thought that, we made one decision at this meeting, and that decision was to raise the federal funds rate by 25 basis points. The projections are really just individual projections. They're submitted and then compiled. And, you're mentioning the median as being, 3 and 4 being close. But, I think like any set of forecasts, those forecasts will change over time, and they'll change depending on the way the outlook for the economy changes. So that's really all I can say. It could change up, could change down. I wouldn't want to. For now, these are the best forecasts that people could make, and it could be that if the economy is a little bit stronger or a little bit weaker, then the path could be a little less gradual or a little more gradual.
So it wasn't one factor that was holding. It's kind of the heart of the discussion.
No, I mean.
Okay, Jim.
Mr. Chairman, a quick follow on the trade question and then a productivity question. On trade, what would have to happen in policy, and in particular in potential retaliation from countries around the world, for trade policy to become a concern for the committee's outlook? And then the second question is, you mentioned productivity growth earlier. What's your current assessment of the path of productivity growth, and has anything in policy, any policy change in recent months, changed that assessment?
For trade, what I mentioned is that our FOMC participants reported in that they had heard, concerns which were relatively new about future trade actions, really, and they're seeing it as a risk to the outlook kind of thing. So, and the kind of things people are talking about would be, more widespread retaliation and more widespread actions back and forth kind of thing. I can't be any more specific than that. In terms of productivity, productivity, as I'm sure you know, has been very weak since the financial crisis. It's averaged only about 0.5% a year for the last 6 years, I guess. So that's well below, longer run averages, and it would certainly be a good thing to see it move up. It has moved up just a little bit, but not kind of decisively. And you asked me about fiscal policy and the connection to productivity. I think in the tax bill there are incentives for a tax cut bill that allows expensing of investment should encourage additional investment. That should encourage productivity. In theory, a individual tax bill that lowers tax rates should encourage more labor force participation. So I do think it's very important that we have a focus on productivity in the country. It's not something that we can really do at the Fed, but we're certainly hopeful that there will be supply side effects like that from the tax bill. I think estimates are really all over the place in terms of the amount and the timing of those.
Jonathan.
Chairman Powell, Jonathan Spicer with Reuters. I take your caveats on the dot plot, as it were, but I'll ask another question. In 2020, it shows that policymakers expect the policy rate to get up almost to 3.5%, which is quite a ways, or definitively anyways, above the neutral rate. Does that increase the risk of a Fed-induced recession and decrease the risk of a soft landing? Which is asking in a way about the fiscal policy, and as a follow-up, is that fiscal stimulus starting to lead to questions within the Fed around this narrative of secular stagnation and the economy entering a new sort of low rates environment? Thanks.
I would say that remember that forecasts 3 years out. So you're right. In 2020, there's I think it's 3.4% is the median of the SEP dots for 2020, which is 40 basis points above the estimates of the neutral rate, which I would characterize as, modestly restrictive, modestly tightening policy. But that's 3 years in the future. It's highly uncertain. We don't have the ability to see that far into the future, so I really wouldn't put a lot in that. It could make sense. You could imagine narratives in which that would make sense, but I honestly, I wouldn't put too much on that. Sorry, your second question was?
Secular stagnation narrative, whether fiscal policy is being questioned through the Fed.
We've been through many years of growth around 2%, and I've given a number of public remarks where I've called on the country to focus more on potential growth and productivity and labor force participation, which drive potential growth. So I think it's really important that we do something, do what we can as a country to increase our potential growth rate. I would say in the bill that passed Congress, the Tax Cuts and Jobs Act, there were elements that should encourage productivity, as I mentioned. Encourage investment, which should help productivity, encourage labor force participation. We don't know how big those effects are going to be. We don't know what the timing would be. I think as you look around the table at the FOMC, there's a wide range of views on the amount and the timing of those. I think all of us would agree that we hope that they will be large.
Michael Derby.
I'm Mike Derby from Dow Jones Newswires. I have a question about the future of the mechanics of monetary policy. Wanted to know whether you favor sticking with the system that you have now of keeping interest on excess reserves and the reverse repo rate to control interest rates, or do you want to shift back to the old way of doing things at some point of targeting the Fed funds market? And do you have any concern that if you do stick with the current system, that as rates rise, that you might see issues where the Fed is being criticized for paying out ever larger shares of money to banks to control interest rates that some might perceive as a subsidy to the banks that are getting this money?
Sure. Our current framework for implementing monetary policy is working very well. We have excellent control over rates, and it's working, and it's as you described it accurately. We haven't made a decision to keep that as our longer run framework. We haven't really addressed that question. We've had meetings where we've talked about it and we've agreed that it's working well, but it's not something I see us as needing to urgently address. I think we're continuing to learn about this framework. For example, in the long run, the size of the balance sheet is going to depend on the public's demand for our liabilities, including currency and reserves. So we don't know what the demand is for reserves in a world where you have you have regulations that require banks to hold lots of high-quality liquid assets, and reserves are one of those. So it's not something we're looking at resolving in the near term. You mentioned the question of interest on excess reserves, and I think it's a little bit of a misnomer to think that there's a subsidy there. We pay interest on excess reserves. We can't pay interest on excess reserves that is above the general level of short-term interest rates. So we're paying rates that banks can get from other interest rates from any other investment in the short-term money markets. In addition, remember that those liabilities, those are our liabilities. The assets that we have on the other side are Treasury securities and mortgage-backed securities, which yield much higher than interest on reserves. So, in fact, it's not a subsidy and it's not a cost to the taxpayer.
Greg, and then Victoria.
Over here. Thank you, Chair. Thank you very much. Greg Robb from MarketWatch. Several of your colleagues recently have been speaking and expressing concern about financial imbalances and rising signs of financial imbalances. I was wondering if you could give us your view on the asset markets, or do you see any bubbles? And do you have the tools you need, you think, to combat those? Thank you very much.
Since the financial crisis, we've been monitoring financial conditions and financial stability issues very carefully, and the FOMC receives regular briefings about the staff framework and sort of measures of various aspects of financial stability risks. And the current view of the committee is that financial stability vulnerabilities are moderate, let's say. And I'll go through a couple of pieces of that. So if you look at the banking system, particularly the large financial institutions, you see higher capital, you see much higher liquidity, you see them more aware of their risks and better able to manage them with stress testing. And if something does go wrong, you've got better ability to deal with the failure of those institutions. So therefore you don't see high leverage, you don't see excess risk taking in great quantity the way you did see before the crisis. If you look at household balance sheets are in much better condition. If you look at non-financial corporations, you do see relatively elevated levels of borrowing, but nothing that suggests serious risks, and of course default rates are very low. So those readings look okay. I should mention also that for large financial institutions, they're no longer funded by a lot of short-term wholesale funding, which can disappear very quickly. So they're far less vulnerable to liquidity issues. Overall, those aspects, I think, suggest low levels of vulnerability. You identified really one area which is an area of focus, which is asset prices. So in some areas, asset prices are elevated relative to their longer-run historical norms. You can think of some equity prices. You can think of commercial real estate prices in certain markets. But we don't see it in housing, which is key. And so overall, if you put all of that into a pie, what you have is moderate vulnerabilities in our view. In terms of whether we have the tools, we have some tools, and I think we certainly will use them. We have, I think the stress test is a really important tool that we have for the largest financial institutions and for the smaller financial institutions. We regularly use that as a way to test against various, market shocks, certainly for the larger institutions.
Hi, Victoria Guida with Politico. More on the regulatory side, the Fed might soon be getting more power to decide exactly which regulations, which stricter regulations to apply to banks with between 100 and 250 billion in assets. And so I had a couple of questions about that. So for CCAR, those stress tests, since that's based around, having a punitive penalty of potentially being able to restrict dividend payouts or stock buybacks, is there any kind of logistical challenge that could be posed if you don't have CCAR every year for certain banks? Is it possible to have CCAR not on an annual basis? And then my other question is, you've talked a lot about how size isn't the only thing that causes banks to pose a systemic risk. And I was wondering, what other factors do you think would cause a bank to potentially pose a systemic risk?
Okay, so this is a matter that Congress has under consideration. It's not something, so Congress is looking at raising the threshold for applying enhanced prudential standards from 50 billion to 250 billion, while leaving us with the ability to reach below 250 billion and apply those standards where we think it's appropriate. And we haven't been shy about doing that because, of course, one of the 8 SIFIs is below 250 already. So we are fully prepared to do that. But this is a decision that's in the hands of Congress. It's not something that's been taken. The version of the bill, I think, that passed the Senate did give us the ability to do supervisory stress tests periodically as opposed to annually is the language. We haven't made any decision about that at all. We would want to think very carefully about that, and we would, whatever we do decide to do, we'd put that out for comment. Is it logistically possible? I would think it would be, but it's certainly not something that we've decided to do. And the second question you had was
about what causes banks to pose systemic risk beyond size.
Sure. Well, it's I guess the next thing on the list would be activities. So we regular way commercial banks that do deposit taking and lending and don't speculate in markets. That's one business model. Another business model might be, maybe think of a hedge fund, right? That's what they do. They're speculating on markets, and so very different business models and different levels of risk and that sort of thing. So that would be the next thing on the list. There would be a range of things. How well capitalized is the institution, but mainly those things.
Okay, Mike and then Donna.
Michael McKee from Bloomberg Television Radio. I'd like to go back to the idea of the additional growth that you're getting from the fiscal package and ask you how much you think comes from the supply side and how much from demand. You used words like might and should about what results should come from this process, but around the table, did any of the presidents or governors report that businesses are actually getting ready to spend? Is this something that's going to happen? Do we know that there's going to be a supply side effect, or are you just guessing at this point?
Remember that there are 15 FOMC participants, and each of us has his or her own forecast. So there's a real diversity of views on this, particularly on these fiscal issues. If I could try to summarize, it would be that I think, broadly speaking, participants believe there will be meaningful increases in demand from the new fiscal policies for at least the next, let's say, 3 years. I think there's a general view as well that supply side issues, that there could be supply side effects as well. And you would see that again through higher investment driven by lower corporate tax rates and the expensing of some investment, which would tend to drive productivity over time. If you make investment more attractive, companies should do more of it. It's uncertain, though. And I mean, I spent many years of my life working with companies and discussing, and the cost of capital is one of many factors that they'll consider. It isn't the only factor or the principal factor, but it should result in more investment, and investment should drive productivity. At the same time, I mentioned labor supply. You should see some labor supply effects over time from lower individual effective tax rates. The whole thing is very uncertain, and particularly the supply side effects should and would be expected to take longer to appear, and would be less certain in amount. So that's really as good as you can go. We've all looked at the literature carefully. We've all thought about it. We've discussed it with our in-house experts and come up with our own views, and they're disparate. But I'd say that's about where the views are.
Okay, Donna and then Nancy.
Hi, Chair Powell. Donna Borak with CNN. Just to go back to trade policy, if you don't mind, you said that participants today generally feeling that the trade policy shouldn't necessarily affect the current economic outlook, but I am wondering if there was any discussion, if there are fears about inflationary effects, should there be trade barriers imposed? And secondly, we might be on the verge of a tick-for-tack trade war with China. Wondering what your thoughts are of how that might dampen the global economic outlook going forward, should that occur.
At this stage, what our FOMC participants discussed, it was just that this is a new risk that had been probably a low-profile risk, which has become, a more prominent risk to the outlook. That's really what people were saying. They didn't get into talking about particular, whether it's inflation or growth or whatever it would be. So that's not something that did come up. Your second question, sorry, was China?
Yeah, I mean, in the event that the United States and China, in the event that the U.S. and China end up in a tick-for-tack trade war or any other retaliatory actions that are imposed elsewhere against the United States, what that means for the global economic outlook, and whether that was something that was discussed, and are you worried about?
That's not something that came up in particular. And let me say, we don't do trade policy here at the Fed, and I would be reluctant to comment on any particular situation with any particular country.
Nancy, and then Virginia.
Nancy Marshall-Genzer with Marketplace. Does the interest rate hike today suggest that Americans are being paid enough? Are you satisfied with the rate of wage growth right now?
As I mentioned, we've had unemployment decline sharply since, I guess, 2010, when it peaked at 10% and down to 4.1% now. And we've seen only modest increases in wages. So on the one hand, what wages should, in theory, represent is inflation plus productivity increases. You should get paid for your productivity plus inflation. And productivity has been very low. Inflation's been low. So these low wage increases, in a sense, they do make sense from that perspective. On the other hand, as the market has tightened, as labor markets have tightened, and we hear reports of labor shortages, and we see that groups of unemployed are diminishing and the unemployment rate is going down, we haven't seen higher wages going up more. And I think I've been surprised by that, and I think others have as well. In terms of what's the right level, I don't think I have a view on what the right level of wages is, but I think we will know that the labor market is getting tight when we do see a more meaningful upward move in wages.
Virginie Montet with Agency France Press. If the economy behaves as the Fed is predicting, by the time of the midterm elections, the rate will be keep on rising, and the prime rate will be well above 5%, a level not reached in 10 years for what is the base of consumer credit. And we know that historically, raising rates, especially in campaign times, has never been very popular in the White House. Does this prospect of a possible pressure and dichotomy of concerns keep you awake at night?
No, that doesn't keep me awake at night. We don't consider the election cycle. We're looking very carefully at our assigned responsibilities of maximum employment, stable prices, and that's really our focus. You can count on us to stay focused on the jobs that Congress has assigned us, and count on us to use the tools we have to achieve them. You're right, that's the highest rate. By the way, I'm hearing the 10-year thing a few times these days, and it's true that rates are higher than they've been in 10 years. On the other hand, the economy is healthier than it's been since before the financial crisis, so it's a healthier economy than it's been in 10 years. The financial crisis, of course, was just really getting going 10 years ago.
Okay, Miles for the last one.
Thanks, Miles Eldon, Yahoo Finance. Chair Powell, I'm curious if the Fed would be willing to tolerate an inverted yield curve. We've continued to see the spread between the 2-year and the 10-year tighten, even with longer-term yields coming up since the beginning of the year. This is a dynamic that has typically preceded recessions, and we're likely to see shorter-term rates come up as the Fed continues to increase rates. So I'm just curious if you guys have discussed that, if you'd be willing to push back against that, if that's a dynamic you'd be comfortable with.
It's an interesting question, and there are a range of views there. I mean, I think it's true that yield curves have tended to predict recessions if you look back over many cycles, but a lot of that was just situations in which inflation was allowed to get out of control, and the Fed had to tighten, and that put the economy into recession. That's really not the situation we're in now. So I don't know that I don't think that recession probabilities are particularly high at the moment, any higher than they normally are. But having said that, I think there are good questions about what a flat yield curve or inverted yield curve does to intermediation. It's hard to find in the research data, but nonetheless, I think those are issues that we'll be watching carefully.
Okay, thank you.
Thank you very much.
And that was Fed Chairman Jerome Powell delivering his first news conference. It was a little bit shorter than what Janet Yellen, his predecessor, usually delivered. She went about an hour. He went about 45 minutes here. Quick, crisp answers.
He was very crisp. He really seemed to motor through them. We noted that right away. Sort of less ponderous than perhaps other Fed chairs in the past, but I think we learned quite a bit, and very interesting stuff.
What I found interesting here was that he sounded more comfortable discussing asset prices, liquidity, bank stress tests. It's where he kind of expanded beyond just answering the question. A little more perfunctory on economic theory. I suppose it makes sense. He's not an academic, right? He's not steeped in economics the way Janet Yellen was.
Right. He was certainly comfortable talking econ, but he did not speak in sort of that academic, more verbose style. I mean, Janet Yellen and Ben Bernanke, both excellent communicators, of course, but no question that he was a little more, I think, direct and blunt. Late in the press conference, interesting questions about wages, Phillips curve, stuff like that. He was just very blunt. He's like, he was surprised. He's been surprised that wages haven't been higher. Wages should go up relative with productivity and inflation. They haven't. And he was pretty straightforward on that.
I like what Luke Cabo wrote. He's a Bloomberg Markets reporter. He observed that when you contrast and compare and contrast Jay Powell versus Janet Yellen, different diction, same message. He's a little blunter in his responses, and that kind of, that really came through. You had observed that there are no Bitcoin questions, which is kind of a sign of the times, because last time around,
I do think there was one last time, right? And so that was, of course, in the
cryptocurrencies was brought up in general.
So it kind of shows how people's interests have kind of moved on. The fact that no one asked.
And one question on balance sheet reduction, if I remember correctly, there wasn't a whole lot of time spent on that, and that's something Jeff Rosenberg had echoed as well.
And speaking of Jeff Rosenberg, the question he wanted to ask was how Powell is really thinking about the fiscal stimulus and the various transmission mechanisms of fiscal stimulus. And our Michael McKee delivered asking that question. And he was basically said it was uncertain the degree to which fiscal stimulus would boost the economy. He predicts it will have a positive effect.
Most participants thought it would, yes.
That it would, but they don't really know the degree. And there's hopeful that there's going to be some supply side effect expanding the productive capacity of the economy, but it's still not clear how that's going to be. So, a fair amount of uncertainty there. And I think that uncertainty was reflected elsewhere.
Trade policy, for instance.
Trade policy, absolutely. Jay Powell talking about the Fed doesn't make trade policy, and he didn't tip his hand too much on how he thought that might go and how that might influence Fed policy.
The midterm elections, someone asked about that.
He was definitely not interested in talking anything really.
Well, you were looking at his facial expressions while he was listening to the question.
Yeah, there was a question, and it involved 10-year rates and tightening in the midterm elections. And you could see on his face, as the question was going, his disinclination to get too far down that road.
Yeah.
And the question ended with how much does that keep him up at night? And he said, no, it doesn't keep me up at night.
It doesn't keep me up at night at all. Yeah, the Fed does not get involved with that at all. He also, with regard to trade wars, said this is a new risk. It's a low-profile risk that has become a more prominent risk to the outlook, but still something that they're not really going to respond to in the moment. We don't do trade policy at the Fed, I believe, was the direct quote there. Michael McKee joins us now not by phone. He is there live at the Federal Reserve. Michael, you asked the question regarding additional growth from fiscal policy, how much would come from demand versus supply. What was your takeaway from what he responded, and in general, his overall theme, his overall message to reporters there?
Well, I think Joe nailed it when he said there was so much uncertainty, and that was certainly the way Chairman Powell was talking about the supply side of what we get from fiscal stimulus. There was a lot of this should happen and this may happen and we expect this to happen, but no real certainty about that. He was much more certain that we would get demand side. In other words, people are going to spend more money, consumers are going to spend more money, which by itself should be more inflationary, and therefore the Fed should and maybe is already reacting to that with this steeper path of rates. Because we're going to see a front-loaded demand-side-led increase in growth, the Fed feels it has to move up its rate increases and get there sooner rather than later. But do we get those productivity effects down the road? He's much more uncertain about that. The cost of capital doesn't really drive investment decisions, and so they're not sure what companies are going to do and whether they're going to make the productivity-enhancing investments that would offset the inflation you get on the demand side.
Michael, we were just talking before you got on camera about how it felt like a slightly different vibe than a Janet Yellen press conference, in the sense that he seemed to motor through the question. He was very direct, often didn't go on. Did it feel a little different to you there? I mean, it seems like it was a little shorter, too.
Yeah. It was shorter by about 15 minutes. It was also a little more...